this thought that if you had a really good cash flow on a property, and if you're of an older generation like me, and you're looking to buy an investment property, there might be an advantage to take that cash flow and put it towards the mortgage rather than taking that cash flow and just doing something else with it. You look at how much interest you pay at the beginning of a mortgage, all your interest is paid first. It seems logical that the right thing to do with cash that you have is to reduce the principal because you pay so much interest at the beginning of the mortgage. So what I'm going to do is I'm going to actually take a spreadsheet and calculate the difference between taking your money and putting it against the mortgage and taking your money and doing something else with it. Here's me taking a quick look at that. So I've got this spreadsheet here. Let's say you bought a property with a value of, I don't know, $300,000, and you had a 20% down payment, and that would mean that your total mortgage amount would be $240,000. Let's assume there's a small amount of rehab that's needed, plus your closing costs. So let's take that to $20,000. And mortgage interest rate, let's call that 4%. Amortized, let's go for 30 years, and that tells you what your monthly payment is. Market appreciation, let's say that the market is going up in this area by 3%. Let's go 5%, doesn't matter. Not 3%. Net cash flow, let's say that this is cash flowing really well and you're making $1,500 a month. The cash flow rate of return, so if you were to invest this money, let's say that you wanted to invest it in the stock market and you were doing really well and say you were getting 8%. There you go. So there's the basics, a $300,000 property, 20% down, $240,000 mortgage. Let's see what that does to the mortgage itself. So option one would be to take that excess money and just invest it. So here's the mortgage calculator for that. Over the 30 years, you'd have 42% of your payments would go towards interest, and only 58% would go towards principal. And if you look at, I'm going to look at this at 5 years. So let's say you want to get out in 5 years. No matter what, you're getting out of this property in 5 years. So what happens at the end of the 5 years? You'd have $217,500 left on the mortgage. The other option would be to take that money and put it down towards the mortgage. Let's say you had a mortgage that allowed you to do that. You just accelerated your payments. So instead of going over 30 years, you'd be paying this one off in you'd be paying this one off in 16.5 years by taking that $1,500 and putting it at the beginning. So it seems to make sense that 21% of your payments only now would go towards the interest and 79%. This looks logical that the right choice to make would be to take that $1,500 and apply towards the mortgage. Now let's just look at what really happens. So if we look at option one, I'm going to get rid of this thing hiding this here to see what happens here. So your property value, so this shows the escalation at market appreciation of 3%. Cash flow of your investment, so you're taking that cash flow of $1,500, and let's say you compound it at 8% monthly. So that $1,500 a month would turn into $110,000. And your mortgage balance at the end is $217,000. So your returns, the three pieces of returns, are your market appreciation of $37,000, so the difference between the value and the initial value and the end value. Your cash flow is $110,000 invested compounded at 8%, and the principal reduction is $22,000 for an overall returns of $170,000. Your initial investments are $60,000, which is your down payment, and $20,000 in reno, so $80,000. You do the calculations, and you get a 5-year ROI of 213%, which is pretty decent. Hide that one and go back to this one. What happened here? Well, on this one here, these are the same. So your property value goes from $300 to $337. Your cash flow, well, you've just got $18,000 that's been paid towards the mortgage, and your mortgage balance is reduced to $117,000. So what happens here? You've got your returns are your market appreciation of 37, the principal reduction of 122, and a total of 160. Your initial costs are the same. $60,000 was the initial down payment. $20,000 maybe at 80. So your 5-year ROI on this one is $200,000. So in this case, very, very close, $170,000 versus $170,000 in returns for an ROI of 213 versus 160 for 200. In this case, it actually makes sense to take your money and invest it in the stock market. Here's a caveat. If you're going to spend that cash flow, so rather than having an 8% return, you've got a 0% return, the math is a lot simpler because your ROI is, you're definitely better off to take that money and put it towards the mortgage and get a 200% return versus 188% return. So what that means is that it really, it depends on what you do with the cash flow. So, and if your cash flow, let's say you get 4%, it's exactly the same number. So you're taking your money and you're investing it compounded at 4%. It's the same thing as if you take that money and put it against the principal. Seems a little counterintuitive because all the money going into your mortgage is at the beginning. But if you actually take that money and invest it, that's good. It also makes sense to think about the tax treatment of the two options. In option number one, where you're taking the money and you're investing in the stock market, the returns are treated as income, so you're getting taxed at a higher tax rate. On the other hand, on the other one where you take your money and you put it towards the mortgage, you're reducing your principal in a tax-free way. However, in Canada anyway, the interest that you pay on your mortgage on an investment property is a tax deduction. So they come out to be a wash depending upon your taxable income. So the tax treatment isn't really a question here. The only question is what you do with the cash flow. If you're not going to put it towards the mortgage, you need to do something with it, or the best thing to do is to put it towards the mortgage. Where the magic really is here is if you take that 4%, or if you take that cash flow and you use it towards another investment, and you get an investment that's going to return you somewhere in the neighborhood of 20%, because you're talking about real estate, so you got a 20% investment. It becomes clear here that taking that cash flow, investing it towards another income property would be the right thing to do, where your ROI goes from 200% to 267%. I needed to do this math to validate the thinking for myself. Hope that helps you if you ever wind up in the quandary where you're wondering what to do with cash flow, put it against the mortgage or invest it.